Hi everyone, and welcome to today's exclusive webinar brought to you by Longbridge. We are thrilled to have you join us for an exciting and insightful session on smarter investing with ETFs. In today's dynamic and market environment, many investors are looking for smarter and more strategic ways to grow their portfolios, and ETFs have become a powerful tool in that journey. We are very excited to be partnering with Global X ETFs, a leading ETF provider known for their innovative and forward-looking strategies. And joining us today from Global X is Lizzy Liu. She's an ETF Research Analyst at Mirae Asset Global Investments and Global X ETFs. Lizzy specializes in thematic ETF research, exploring some of the most transformative trends shaping global markets. And prior to her role at Mirae Asset, she worked as an equity research associate at CLSA. And she also holds a bachelor's degree in economics and finance from the University of Hong Kong. Her deep expertise in both the Chinese and global markets makes her the perfect speaker to help us navigate today's topics. And in today's session, we'll be diving into three exciting areas of ETF investing. So firstly, will be the covered call strategies to learn how these income generating ETFs can help manage risk and boost returns, especially in the volatile markets. And followed by diversification made easy to actually see how Global X's range of ETFs can help you build a well-balanced, globally diversified portfolio. And also China's thematic opportunities to gain valuable insights into high growth sectors such as core tech and semiconductors in China, and how thematic ETFs can help you tap into their potential. And with that, let's welcome Lizzy Liu from Global X to take us through these exciting themes. Okay, Lizzy, over to you.
So hi everyone, I'm Lizzy from Global X Mirae Asset. So firstly, maybe let me start with a brief introduction in our company. So our group is founded in 1997. So Mirae Asset Global Investment is one of the leading AM firm in Korea, and our financial group includes different business lines, including investments, securities, life insurance, and others. And currently, our global ETF platform has over like 100 billion US dollar AUM, and we have operating across globally, like including Hong Kong, India, Korea, like also US and like Europe. So let's just cut to our investment strategy and products related today. So firstly, as we know, currently the market is quite volatile, and we believe investors can holding both like defensive strategies product and also like thematic growth products to have like a more balanced like portfolio, and also to better benefit from the current market situation. So firstly, we want to introduce the cover call strategy and our related products. So we have two newly listed like cover call products based on US indexes. One is called S&P 500 cover call active ETF with a ticker 3415, and another one is a Nasdaq 100 cover call ETF. And these two products is just launched in August and September end respectively. So let's start with some like basics. So for our listeners who might be new to this strategy, let's touch on like what is cover call strategy first. So for the cover call strategy, you can think of this strategy has like two parts. So firstly, you would own a basket of stocks, or you would own one index. Secondly, you will sell the corresponding call options. So in return for the selling the call option, we can collect a payment which is known as the option premium. So the option premium is like the primary source of the incomes for our cover call strategy products. So if we see the chart here, for the the top left chart, it shows the return for holding an index or like relevant the stocks, and the bottom chart shows the return for selling a call option. So if we put these two together, we will have our cover call strategy payoff, which is the chart as the orange line showing in the right chart. So if we there are a few like features for the cover call strategies. So if as we are selling the call option, so the upside potential is actually capped for owning the comparing to owning the index. So in other words, we cannot enjoy the whole upside return if the stock appreciates beyond the strike price. So we are like changing like the stable income from the upside potential that we give up. And secondly, the option premium usually correlates with market volatilities. So we will have higher option premium if the market gets more volatile. So this can also offer a potential like risk management to in the like volatile market situation. And thirdly, there is no additional downside protection beyond the premiums that we have received. So in other words, the cover call products are not those so-called capital protected products. It can offer downside cushions, but only from the amount that we receive from the option premium. If we have losses beyond that amount, we cannot offer like further protections. So if we look at like three different market situations or scenarios. So firstly, on the left side, if the market is like an uptrend situation, the return for cover call investors usually are still majorly from the option premiums. So in other words, the upside potential is capped and investors cannot enjoy the full capital appreciation from the index. So in this case, cover call usually will underperform the general market index. Secondly, in the middle of the for the middle chart, so if the market is like a volatile situation, so usually this is like the ideal or favorable market situation for cover call strategy, because as we mentioned, the option premium it tends to increase along with the market volatility. So in this situation, the cover call strategy usually will outperform the general market index because we can enjoy higher option premium, and maybe we can also enjoy the slight increase from the underlying index as well. And lastly, if the market is like in a downward trend, which is like the chart showing on the right, so investors can, as we mentioned, can still receive the option premium through selling the call options. But the option premium can only partially offset our loss. So in this market condition, the cover call strategy usually will outperform as well. But as we mentioned, this is not like a fully capital protected. It can only partially offset our loss. So the Nasdaq 100 cover call and the S&P 500 cover call is like applying the cover call strategy we just explained on the S&P 500 index and also the Nasdaq 100 index respectively. So actually, as we know, there are similar S&P 500 and Nasdaq 100 cover call ETFs trading in the US market as well. So why are we like still launching similar products in the Hong Kong market? What is a key advantage here if we choose a Hong Kong listed products? The key difference is from the tax. So in general, the foreign investors, which means means the non-US investors subject to around 30% US withholding tax on the cash dividends distributed by the US listed stocks and ETFs. So unless your country has like tax treaty with the US, the withholding tax may like apply to like different levels. But in general case, it's like a 30% dividend tax. So although investors might get some of the those like the withholding tax back, but it usually will take longer process, and it would require some extra like time and efforts. However, our Hong Kong listed ETF is there's no dividend tax applied. Therefore, it's like more tax efficient for our investors. If we put some numbers for like a simple calculation, so imagine both US and Hong Kong ETF has like around 10% distribution yield. For the US ETF, generally the foreign investors might only see 7% return after the 30% withholding tax. But with our Hong Kong listed ETF, you actually can keep the full 10% distribution, and there will be around 3% difference, which will go directly like into like for our investors like return. So that's like the key tax difference between the Hong Kong listed ETF and the US listed ETF, especially for the distributions. As we know, our cover call ETF usually the targets to deliver a monthly distribution. So therefore, accumulated there will be like some like difference for our investors' return. And this slide shows like the option premiums. As we can see, the option premium correlates with our with the market volatility. So usually, if the market gets more volatile, we can have higher option income. So if we take the historical premiums for reference, we can see for our like S&P 500 index for the past 3 years, the average premium is around 1.97%, with a median at like 0.93%. And for the Nasdaq 100 index, the average premium would be around 2.56%, with a median at 1%. So the option premium that we can see from here is that the Nasdaq Nasdaq 100 index usually has higher option premiums compared to the S&P 500 index. This makes sense, as we mentioned. The index, the option premium is like in line with the market with the index volatility. So Nasdaq 100 index usually is like more volatile, so therefore it will have like higher option premiums. And this chart also shows the different volatilities like across different markets. So we can see Hong Kong index is actually usually have like higher volatilities comparing to those US indexes, and the Hang Seng Tech index has like the highest volatilities as the chart shows here. Therefore, if we take a look at the option premiums comparison for major indexes, we can see Hang Seng Tech also has like the highest premium, average premium at 3.9%, and the Nasdaq usually at 2.6%, and S&P at around 2%. We see the cover call strategy can also serve as like a diversification tool for our investors' portfolio building. So for example, if we take the perspective, if we take we see from the market or the region allocation perspective, if we see the correlation analysis between the US and Hong Kong market, we can see that the performance of the two markets actually showed some difference over the past decade, which means if we have some positions in the US index-based products, it can also offer like valuable diversifications for our like Asia investors. And if we take the perspective from the sector allocation, for those risk-averse investors, we usually tend to underweight the growth like style sectors, such as those information technology, communication service, and also like consumer discretionary sectors. However, if we see the sector allocation for the Nasdaq 100 and S&P 500 index, we can see these two indexes, they relatively have like higher sector exposures to those high growth sectors that we just mentioned. And our cover call strategies are trying to like monetize on those volatilities of those sectors. Therefore, it can potentially like help our investors to achieve the portfolio diversification from the sector allocation perspective, and also we are like can benefiting from those high growth sectors, which usually have like higher volatilities. And this is like the brief introduction for our two US index-based cover call products. As we know, we also have the Hong Kong index-based like cover call products. The one we want to highlight here is the 3416, the cover call products based on the Hang Seng China Enterprise Index. So actually, our Global X platform is like a global leader in the cover call strategy. So we have extensive experience running those products in the US, Canada, Korea, and also in Hong Kong. So before the two US index cover call product we just mentioned, we have already successfully launched 3 other like cover call ETFs based on the Hong Kong indexes, and the 3416 is like one of them. And we also have another 2 based on the Hang Seng Index and also Hang Seng Tech Index. So our 3416 it has actually has like more than 1 year track record of delivering consistent monthly distribution to our investors. So over the past 12 months, we see the 3416 has distributed around 0.14 to 0.15 Hong Kong dollar per share, which implies a monthly distribution yield at around 1.3 to 1.5%. So the total distribution yield for the past 12 months is around 17% for this product. So we can also see that each month is, for the distribution yield for each month is actually less than the option premium yield that we have received. Therefore, it supports our stable monthly distributions like going forward. But here we also want to do a risk disclaimer that the monthly distribution is not guaranteed, and it can be made from the capital in any case. So the amount of distribution is also not guaranteed, is subject to our PM team's decision. So yeah, this is like the risk that we want to highlight from here. And also going forward, we might further expand our cover call product lineups. So we believe this can provide our investors a broader range of options to access the benefits of the cover call strategies. To quick recap on the cover call strategy. So this strategy is like an effective way to generate income, especially during uncertain uncertain or like volatile market situations. However, if we want to manage this strategy by our investor yourself, it might be complex and time-consuming. So therefore, we believe our cover call ETF products can help investors like with a single, easy to trade way to have like access to this strategy. And beyond the income perspective products, we also want to highlight two more like growth like style products, our thematic products. So as we know, China tech is like currently is like at the center of the market interest, and we have a China core tech ETF with a ticker 3448. So this product, like the reason why we launched this product is that we see the current world is entering like a G2 tech era. So we see the future tech, we believe that future tech developments will be certainly around the US and China, the two major countries. And currently we have seen like China is like catching up their R&D capabilities. So we see China has surpassed the US in the Nature Index in 2024, which is like a key indicator of the science and technology level. And also China is overtaking the US in the Nature Cancer Research 2025, where the US was like originally strong. And we also see China is on par with the US according to some critical technology index released by the Harvard University this year. Therefore, we see China is like ramping up on their R&D process, and we believe those are crucial to the long-term tech development. So if we take a look at the China core tech ETF or the index, if we compare it with the Hang Seng Tech Index, we can see the index is actually like outperforming over the past few months. Maybe like firstly, let's touch on the China core tech index methodologies. So this China Tech Top 30 index is like from the China listed, which means Asia, Hong Kong listed, and also US listed, those ADRs, Chinese companies. So we choose sectors that is most directly related or relevant to the technology things, and we would rank those companies by the market cap, and therefore we get the top 30 China tech companies, which means it's all like large cap companies and also like industry leaders across those major tech categories in China. As we know, like industry leaders, usually they can enjoy many benefits. They have stronger competitive moats, and also they would also like enjoy better like policy support and etc. And if we further take a look at the sector allocations for this ETF, we can see that this ETF actually offers like a very diversified exposure to those high-tech sectors. And as we can see here, we have exposures to semiconductors, biotech, batteries, and also consumer electronics, and also like EV and supply chain. And we also have like exposure to robotics and solar and medtech and etc. So those are all like key major high-tech like industries in China. And if we see the key holdings there, we can see it's all like industry leaders, and which are attracting many like investors' interest. As for example, the semiconductors, we have SMIC, we have Cambricon. For the EV, we have BYD. For the battery, we have CATL, and For the robotics, we have Sanhua, and etc. It's like all like industry leaders with high market interest and high liquidities. And this portfolio is actually like, as we mentioned, it's like composed by all high tech categories, where we believe China can become like global leaders in the long term. And if we compare to the Hang Seng Tech index, actually our portfolio, the China Core Tech portfolio, doesn't include those internet names, which we will explain later. And also, as we mentioned, because this portfolio is like screened or ranked by the market cap, so it's like all the holdings are all large cap leaders with an average market cap at around 6 billion US dollar. So if we compare the sector allocation with the Hang Seng Tech index, we can see that actually Hang Seng Tech index is like highly concentrated on the internet names with more than 50% sector exposures to internet. However, for our China Core Tech, it's like more balanced like sector allocation. Like across like various high-tech subsectors. And the reason why we didn't include internet stocks in this China Core Tech ETF is because we think for those Chinese internet companies, it's not easy for them to like become global leaders or to expand overseas, as U.S. internet companies are already dominated in this area. And the investment theme for our China Core Tech ETF is like those high tech areas that we believe China can actually like leading like going forward. Therefore, that's like why internet company names are not included. And also we believe these like kind of sector allocations can better like help investors to have more like diversifications for their portfolios, as like Hang Seng Tech is actually like well owned or like commonly owned by investors in Asia or like especially in Hong Kong. And this product, it also provides like A share plus H share exposure. As we can see here, our portfolio has around like 40% from the China A share, while Hang Seng Tech is like fully like 100% H shares. We believe this can also, provide some market diversifications, especially like year to date when the H share has like rallied strongly, and H share can like catch up the year to date performance in our view. And also we see our portfolio has like a higher R&D ratios at 30%, comparing to Hang Seng Tech at 10%, MSCI China at 4%. And we believe the dedicated investments in the R&D is like the cornerstone for companies who want to seek to establish like a long-term like industry leading position and to like ensure their competitive advantage in the rapidly evolving like technology like industries. And also we can see our China Core Tech ETF, it has actually better growth profile comparing to the Hang Seng Tech. As we can see, the revenue CAGR is like at 17%, higher than the 11% for the Hang Seng Tech index, and our MP CAGR is also like better at like 23% compared to Hang Seng Tech only like 16%. This is because our portfolio is like composed by those large cap industry leaders who really has like better competitive advantage and also like better balance sheet and also like better margins. Therefore, we can see this like better like growth profile for our portfolio. And if we take a look at the historical performance, we can see like over the past few months, the core tech, the China tech top 30 index is like outperforming the Hang Seng Tech index. And here is like the product page summary for our China Core Tech ETF. A quick reminder is that we have very balanced or like diversified sector allocations, and we know that the technology industry is like the market volatility is quite high, and we usually also see like the sector allocations. Like for example, for the past quarter, I believe the semiconductor is like leading like the performance, but now we might see the sector rotation to like AI names or like robotic names, or before the last quarter's rally in the China semi industry, the biotech is like the major focus or like the key outperforming area in the China tech industry. So we keep seeing those sector rotations between like different subsectors. However, those key subsectors are all like included in this China Core Tech ETF. Therefore, we believe it's like more balanced access to the overall China high tech industries. And if investors who want to have like more focused like investment in some like key tech industries, we also have some others like thematic products like the China Semiconductor ETF with a ticker 3191. As we know, the China semiconductor industry has like performing very strongly, especially in the last quarter. So this is like mainly driven by recently intensifying like domestic substitution story. So we see the sentiment got like a major boost. Firstly, it's like with a report, with like some media reports in August saying that NVIDIA was like stopping some productions for its H20 GPU, and then we see the launch of the DeepSeek new V3.1 model, and DeepSeek has mentioned that its new V3.1 model is upgraded for faster processing and also a new precision format, which is like optimized for next generation domestic chips. And after that, we see the bullishness was like further amplified by a media report in September, saying that China bans tech companies like including ByteDance and Alibaba from buying NVIDIA's AI chips. And in the same month, we see Huawei unveiled its like very ambitious 3-year roadmap for its AI chips. So Huawei is planning to launch 4 more advanced chips by the year of 2028, which is like challenging NVIDIA's dominance in this area. And also we see for the China semi-equipment sector, SMIC, which is like the leading China semi-foundry company, is testing a DUV lithography machine made by the Yuliang, which is like a Shanghai-based startup. So this is like the first domestically produced advanced chip making equipment, which is like in line with the industry's trend of improving the localization. So although we acknowledge that the DUV machine still lacks behind, maybe like a few generations behind the cutting-edge EUV machine, which is dominated by the ASML. However, we see this ability to produce advanced DUV machine can also still like represents a process or like a victory for China's ability to overcome U.S. controls on those chip exports sanction to like reduce China's reliance on the Western technology and also into increase the production capacities of their advanced AI processors. So we see all those industry news and developments underscoring that the urgency and also the efforts that China has been like applying to achieve the technology self-reliance. So if we see from a broader like picture, we see that China brands actually accounts for around 35% of the global semi demand, but the local firms only account for around like 7% of the global semi capacity supply. So this gap brings like a relatively low localization rate in China for China semi industry at around like 24% in 2024, according to Morgan Stanley's data, especially for some like specific semiconductor devices, for example, the lithography that we just mentioned. However, we believe with the ongoing tension between the US and China, especially like when US is like applying like stricter like sanctions on China semi industry, we believe this will like support the China's like self sufficient and localization trend, and this trend we believe it will be ongoing and it's like substantial growth like for multi years, and it will benefit the domestic players across the supply chain from the foundries, equipments, and also like chip designs and also like other materials to serve the large local semiconductor demand. And beyond the localization trend, we also see the recent rapid AI development plays like a crucial role in China semis demand growth. So as we know, one of the core challenges that China AI chip is facing is a lack or like the shortage of the high-end GPUs due to the US section. However, the launch of DeepSeek has like significantly reduced the demand for hardware computing power, and it has like better performance in inference. So therefore, domestic AI chips can be is likely to be like more adopted in the China market, even though they might still like behind the global like cutting edge ones in terms of performance, especially like in those computing power and data speed perspective, but they're good enough, and also they would bring like this will bring a wider AI applications with a cheaper cost, and also like find like a way out like under current restrictions. So we see the rapid development of the frontier AI models and applications in China can drive significant growth in the China semi industries and also the AI compute demand as well. So we also see there's like a expansion cycle in the cloud capex, especially when like giants like Alibaba and Tencent, they are all significantly increasing their capex investment in cloud. And all those money, like eventually it will like benefit the China semi supply chain to support those compute demand. So according to the Morgan Stanley's data, we see the AI spending acceleration is expected and China cloud capex is expected to increase by like 48% in 2025 and 15% in 2026, which will like benefit the entire AI hardware supply chain. And also, we see a distinct domestic AI ecosystem is also taking shape. This is like built on the local computing power and also local large models. So this will create like a self-reinforcing cycle for with domestic AI hardware and plus domestic computing power and models. Another key catalyst or like support we see in the China semi industry is the strengthened government support and the government's determinations to achieve the technology self-sufficiency. So we see a primary vehicle for this support is the so-called big fund from China government. So we see this the CICIF, the big fund, is actually has been coming to the third phase in 2024, and the initial phase is started in 2014 with like total capital of around 99 billion RMB. At that time, the major investment target would be the IC manufacturing like companies or like sectors such as SMIC, Hua Hong, and also IC Designs at that time. And then goes to we see the second phase started in 2019 with like a major with a registered capital of around 204 RMB billion. So the increased investment goes to some equipment sectors, like companies like Nora, AMAC, and also like EDA and IC design like areas. And the third phase started in last year, 2024, with a registered capital of total capital of like around RMB 344 billion. So we see the total capital is like more than the first two phase combined amount. And this time, the investment targets is like on the full like China semi value chain, and with a major focus on those bottleneck areas like advanced nodes, manufacturing equipment, and also materials, and also like the AI computing power chain, like those GPU areas. So we see like we also believe this is like because also like partially because of the current global situations, as US is like restricting like further restricting the exports to China. And also the third phase would have like a longer investment horizon compared to the first two. The first two, the investment horizon is like around 5 years, and the third phase extended to 10 years. We believe this type of like injection of capital can help to attract more social capitals and further support the domestic semiconductor industry from the long-term perspective. And if we see the right chart, like each time after the fund injection, the China semi industry would see like a good performance. And lastly comes to our China Semi ETF. So this ETF it offers like target exposure to the entire China semi industry value chain, investing companies across different subsectors, including foundry, manufacturing area, including the OSAT, the packaging and testing, and also like the semiconductor production equipment, and also the IC, the chip design areas. So it's like a great success, a great access to the whole China semi value chain. And we see this product also have like over 90% exposure to A shares, which we believe might be like more hard, like a little bit harder for like Asian investors to get access to. Therefore, this ETF can like help investors to gain exposure to those Asia China semi names. So we believe China's like the journey towards the semiconductor localization is like a long-term structural growth trend. So, and also the individual stocks can be very volatile. However, this ETF is like offers a more diversified and balanced way to have the exposure to the entire China semi sectors. And that's all from my side for the sharing. And I will stop here to see if there's any like questions. Okay, maybe I will start from the latest one. There's a question regarding that the Hang Seng Tech Index is like a key benchmark for the Hong Kong market. What's the key difference between the core tech ETF and the Hang Seng Tech Index? Yes, as we also shared a little bit in our presentation earlier. So the Hang Seng Tech Index is like a well-owned like a tech index in Hong Kong market. And if we see the sector allocations here, the Hang Seng Tech has like a major part from the internet names, which is like not included in our core tech ETF. Therefore, we believe sector-wise it can provide some diversifications for investors who might already have the Hang Seng Tech Index. And also we see the sector allocations here. It's like quite balanced and like very diversified like sectors across all those like high tech areas. So we have semi, we have biotech, and we also have EV battery supply chain, etc. We also have like those robotics. Those are all like high growth tech areas that we believe China can become the global leaders going forward. Therefore, I believe that's like the key difference between our core tech comparing to the Hang Seng Tech. And another question on any plans to launch a cover call ETF for crypto. I would say we couldn't disclose any like detailed plans yet, but we will have like a more comprehensive cover call product lineup going forward based on different index or like commodities. All listed, yeah, and this is like wait. Let me jump to the end. And here is the fund map shows our like China, our Hong Kong listed ETF products from our global X. So we have those thematic growth like the China thematic industry thematic ETF products. We also have the income products. For example, the cover call products we just mentioned today. And we also have some other like broad index ETF products like those different types. And we also have some global products as well. So maybe can take a look or like explore more in our Hong Kong website as well. And there's another one saying China tech and semi sectors have strong year-to-date performance, and we also seeing some corrections. Right, we recently there's like a bit like corrections in the market? How do you see the growth sustainability going forward and the current valuation levels? So yes, I believe for example, for the China semi sectors, it has been performing very strong for the last quarter with like over 15% growth like in just one quarter. So with such a strong performance, I believe it's quite normal to see some like profit-taking actions. Therefore, we might observing some like corrections like in the market. However, as we mentioned in our previous earlier like presentation, we believe the for the China semis like localization trend it won't just stop right now, right? It won't just last for one quarter. It's like a multi-year like process, and we continuously to see the government support and like increasing like investment from those tech giants, and those are all gonna like benefiting the semi supply chain and also like some other related tech areas. Therefore, we still hold like positive like views on the China semi and also China tech's long-term growth. And we believe like comparing to the for example the US like tech valuations, China tech's valuation are still relatively cheap, and therefore and also the long-term like growth like revisions can also like support the valuation levels going forward. Which currencies do you recommend for Singapore investors for this fund? So usually for our fund, we have two different currencies. We have Hong Kong dollar and also US dollar. I believe investors can choose based on like what currencies you hold more. So it's like more like depends on your situation. What is the key difference between the three cover call ETFs given the current market conditions? Do you think now is a good time to build the cover call positions? Yes. So for the three cover call ETFs we just mentioned today, and the key difference would be like the index that they're sorry, they are based, and which brings like as the index volatility is different, the option premium is a bit different as well. So if we see the chart, here, I think we have showed the option premium level for like different for some major like indexes across different markets. So usually the more volatile index would have like higher option premiums. As we know, like currently the market is quite volatile. And for example, if we take the U.S. stock market, we see the market has like for example, if we see the U.S. market has seen like a sharp rebound from its lows in the early April, and some investors may be worrying, may have some concerns on like how long this bullishness or like growth can continue. Therefore, we think in this volatile situation or like after like a strong rally, there probably gonna be some like shorter range bond tradings as well. So we believe in this type of volatile situations, cover call ETFs can be like a valuable tools for investors to generate some potential extra incomes and navigate through those turbulent times. So yes, I think this can provide investors a great defensiveness, and maybe like especially during like those volatile market situation. What happens when the option is exercised when the underlying will be called away? Then you will buy back the underlying any statistics how often this happens? Oh yeah, for our covered call products is like I believe it's like 17 or like 80% covered. So usually this situation you mentioned won't happen. At least we haven't seen this happens like in the past from our past track record. But if this happens, we also have some cash on hand, which can settle this situation as well. And for the delta and durations, I believe this, I don't have the exact number to share right now, but I believe for the durations, you can see the option that we have like in our official website. But I don't have the data on hand currently. Yeah. Yeah, I think that's all questions that I have seen. Yeah.
Okay, thank you again, Lizzy, and a big thank you to everyone who joined us today. So, if you are looking to enhance your investment strategies and unlock new opportunities, we hope today's session has given you some valuable insights. And don't forget to follow us on the Longbridge app for more webinars, tools, and market updates to support your investment journey. Okay, thank you, Lizzy, and thank you, everyone. Okay, until next time, happy investing and stay smart with your strategies. Thank you, everybody.
Thank you, everyone.